we are live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Liquor Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I like to call GC, because he knows how to generate cash flow, because he's got some genius concepts he's about to share, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
Great to be back in studio today, especially when we got our community manager, our superstar marketing teammate, Madison Lipsum. Welcome to the show, Madison.
Hello, everybody.
And no guest investor today, right? So we'll just go right into welcoming you. If you're on the podcast, super pumped you're listening right now in your drive, cooking a meal, walking your dog, whatever you're listening in. But I want to encourage you to join us live one Tuesday or Thursday. Go to nyas.com, register for the show, throw it on your calendar, and it'll just pop up there and you can join us. No friction, whenever you're available, so that you can be part of the roll call. You guys ready for the roll call?
Game on.
All right, roll call time. Madison's already in the chat saying, welcome everybody to the Not Your Average Investor Show. Drew Barnhill, the ringmaster of the Not Your Average Investor Show community. Jen Filson, the fairy godmother of the Not Your Average Investor Show community, saying, hey everyone, good morning from lovely Monterey, California. We got John Henning with his trademark, good afternoon all. We got Dean Curry from Ohio saying good afternoon from a cloudy and gray Ohio. I think it's always cloudy and gray in Ohio. Right? Is that what they say in Pittsburgh?
I won't take a cheap shot.
Nadeem Shah says, hi, everyone. Good morning and good afternoon from the West Coast. We got Joanna Batista saying, hello, JWB fam. We got Chris Massengill. I hope we're getting that right. Good afternoon. Chris is a new name. Welcome to the show, Chris.
We love new names.
Checking in. Did you come from the podcast? Did you take our advice? How'd you get here, Chris? Let us know in the chat. Welcome. We got David Blattner. Sorry, that was just a mispronunciation. David Blattner. He says, hi from Dave B in Mass. Welcome, Dave. Good to have you back. Who else we got? We got Ken Moline and Carolyn Moline, the patriarch and matriarch of the first family of the Not Your Average Investor Show. Love having the Molines on board. Mm-hmm. We got Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
That's right. Welcome, Marilyn. Hervé Francois, JWB fam. Hope everyone is well. He's in the house from New Jersey. Good to have Hervé on, star of a recent guest investor.
Hervé's going to love this show.
I think
he's going to love this show.
I think he is.
It's going to be great.
I think he is. We got Louis Hudnall. He's in the house, morning from Milipitas. Miguel Ángel Sanuda. Hola desde España. Good to have you, Miguel Ángel. We got Jillian Noel. She's back. Hello, all. Good to have you back in the house, Jillian. Man, this roll call keeps getting better and better. And I pronounced it correctly. You pronounced it correctly. I am friends with the ringmaster, Drew. All right, Chris.
Oh, wonderful.
Good to have you in. We got Jeff Spiker in the house. He says, time is money. Jeff, that is a new name, new call sign. I welcome it.
Love it. Love how he's thinking.
Camille Jameson is back in the house, the founder of Jameson Financials in Newark, New Jersey, HQ. Good to have you, Camille. Amy Boyd is in the Facebook chat. Amy, good to have you in the Facebook chat. Join us on the show. We got the link there on the registration if you want to be part of it. If not, hang out with us on Facebook. All good. All right. I think we're good. You ready to kick things off?
I'm ready.
With my favorite segment?
Yes.
Madison shares good news. Madison, what do we got going on?
Hello, everybody. Well, I was in the middle of typing William Oxley, Pablo, to say hi to you. So I'll say hi to you. Hello. Good news today, guys. A little bit of a JWB update. What's going on? What are we doing? Well, I don't know if some of you saw the Facebook group or the post in it, but the JW team got out of the office and got to take a downtown tour, one very similar to the one happening on June 24th. If you're coming June 24th, I recommend you do, because it was a lot of fun. Got to see kind of different projects going on, just to hang out downtown. I'm a Jacksonville native, and I didn't even know half the stuff downtown was downtown. So super cool, really good opportunity to see the community that you're investing in. So that's
what was the best part of the tour, in your opinion?
Alex standing on things. Absolutely. No, I'm just all the different ideas, innovation going on downtown. What used to be the landing is now a park and has a lot of cool different things happening there. So just seeing what it was and what it's going to be was really cool.
Amen.
So another really cool piece of good news, Greg and I and Pablo all got to be a part of our K9 for Warriors house giveaway this morning. So if you don't know, now you know. Every year, JWB gives away a house. We partner with K9 for Warriors. and we donate a house to a K9 for Warrior veteran who graduated their program. And today we got to give Jennifer her keys to her new home. So super cool experience, humbling, inspiring, all of the above. So
I tell you what,
that's the good news.
that is the very best news of the entire year right there. So
dropping the mic. We're done.
It's hard to get better than an example of changing somebody's life like we all got to be a part of this morning. And I got to meet Jennifer and I got to meet her family. And it was just like one of those HGTV reveals where she walked around the corner and saw her brand new home. Get this. So we've been building the home for 6 months or 8 months. Jennifer was so disciplined and her family was so disciplined. They did not go and check out the home before today. It was the very first time. And just think about how thoughtful she is. She goes, I said, how did you have so much discipline? She goes, I was thinking about the hundreds of people that were coming together to make this possible for me. And I didn't want to be rude. And I didn't want to take away from the emotion of the moment. Like, can you imagine knowing that you're getting a brand new home, that you live in Jacksonville and not going and checking it out? Like what a thoughtful move there. But this has just been an incredible experience. I want to say thank you to everybody on the show. Thank you to our entire team. Thank you to everybody in our network. You all came together. I'm not joking. It's hundreds of people come together and donate here and donate there and volunteer here and supply materials there to come together to build this home. And we get to have this wonderful day today. So I could talk all hour long about how momentous and how much it means to me, but I want to share it all with you. This is why we do what we do, and we're all a part of this. So thank you all.
Agreed, man. Let that sink in. That was awesome. Thank you for inviting me to it. We got to speak about a couple of, like how powerful it is to be on a mission, right? Like the mission that our country's on and our veterans are on, the mission that K9's for Warriors on, the mission that JWB's on. When you get to intersect with that, right? The mission that the not your average investors are on to create a lifestyle beyond retirement that they really, really like, right? Like that was what was on display. That was absolutely beautiful, man. Very cool. Very cool moment.
It was. And more coming. And if you'd like to help support, you can go to jwbcares.org and you can donate. And our goal, I don't know if we're going to get to it this year, if we're going to do 2 homes this year, that's the goal, right? But the more money we raise, we can have twice as many moments like we just had with Jennifer in 1 year, and 3 times and 5 times. That's where this thing is going.
Love it. Love it. All right. We want to welcome, you said Bill Oxley was checking in with us. I did not call out Bill. Good to have you back. And of course, Bill Shields with his Hola Amigos on Cinco de Mayo today. Welcome, Bill Shields. Good to have you on board here. And before we go any further, I believe we got some breaking news. Gregg, what is the breaking news, GC?
Man, get ready. Buckle up, everybody. We have some really important things that we're going to talk about today. I've been excited about this Thursday show for a long time, probably 2 weeks since I knew that we were going to be bringing forward some ideas that are new, some ideas that I think are really going to help you. So we are going to have this opportunity today to kind of reframe and change how we think and evaluate rental properties, also how we think and evaluate against the other asset classes that we have the opportunity to invest in. And where this all has come from is I've been really frustrated lately. I have been frustrated because I think of all these other asset classes that are out there, and I constantly feel like the other asset classes, we'll talk about the stock market, let's talk about syndications, let's talk about other places you can place the money. I think that these other asset classes get the benefit of the doubt so much, right? We only talk about generally the good things when it comes to investing in the stock market, or we talk about the good things that come in investing with syndications. We tend to throw the maybe not so good things under the rug, right? We don't really highlight that as much. And generally people put their money in the stock market, and that's why they do that. On the rental property side, I just feel like it's not a fair fight. I feel like we always expose the worst things for rental properties, right, as the reasons not to invest. But we don't really talk about all of the profit centers. And it's like, on one hand, we talk about the best things, but the worst things we probably need to expose. And on the real estate side, we talk about how there's not enough cash flow. Maybe it's not going to change your life, right? We talk about how I can't count on home price appreciation. That's what some people say, not your average investors, but other people say that. We talk about how fearful it is to have a leaky toilet and get a phone call, right? We don't talk about all of the profit centers. So I'm frustrated. I've been frustrated for a while. fans of the show, you probably have seen me, talk at length about trying to share these other profit centers with you. And I'm fed up. So we talked internally a couple of weeks ago and we said, listen, if we are really going to help our clients, if we're really going to help our not your average investor community, we need to create this scoreboard. We need to have one place where you can analyze your decision. If that's investing in the stock market, I think there's a time and a place for that, right? But we need to be able to compare apples to apples for that investment to your rental property investment. If you're investing in syndications, there's a time and a place for that too. But you need to compare apples to apples. You need to know the lingo. You need to know the risks. You need to know the upside of each. And so I'm super fired up, as you guys can tell right now. I'm super fired up because we now have adopted that. And that's what the baseline of our property evaluations is. It is this scoreboard. We can use this to analyze rental property investments with JWB. We can use it to analyze it against syndications where you might be thinking about placing your money. We can use it to analyze the stock market. We can use it to analyze anything you guys want to analyze. And it's now right there as our property evaluation. So with this being the property of the week, we thought this was a great time to unveil it. So there you go.
Do you see, as we were talking about this, right? This change from, and I don't know if you've mentioned it, but it's a change from focus on ROI to focus on IRR.
Yes.
Right. And we're gonna dive into that. We're gonna dive into the difference between ROI and IRR in a second. But to me, more interesting is your source of frustration. Your source of frustration, knowing you well, you don't often articulate this, but it all stems from this idea that you believe that Americans are underinvested in rental income properties.
I do.
Tell me more.
Well, I just think if more people had the education to understand that there's an asset class out there that both mitigates risk better than your alternatives and also has a high upside, higher than most of all of your alternatives out there, that more people would be investing in it. And that's what you have in rental properties. And so I think it's a lack of education. And so with us having a platform here, I feel like I can help folks at least see what you're giving up by choosing those alternatives. I think the world probably needs more consistent income. We need more risk mitigation in our investments so that we can all sleep a little bit easier and make better decisions with our families and our communities and have passive income coming in so we can choose to do what inspires us with our active income, with our active jobs, rather than maybe what we have to do. I think the world can be a better place. And I think rental properties can do that for people. And so I'm really happy to compare apples to apples. And I think we now have the ability and the platform and the evaluation tools to be able to do that.
Love it, buddy. All right, man. Well, let's jump into this thing. Before we go to our property, it looks like the Colorado delegation that just hosted our IRL, Not Your Average Investor Show meetup. Maybe they're a little hungover because they're joining a little bit late. Leslie Wilson's joining a little bit late. Carl Thompson's joining a little bit late. I know I got to talk to Carl over the weekend while they were hosting the IRL meetup. We got a cool video that's coming out that Jen's going to share with everybody sometime soon. But I want to say thank you to the Colorado crew, our fairy godmother Jen out there, sprinkling her magic wand and making connections, and you all being so gracious enough to host us in Colorado, and making some connections mile high.
Love it.
All right, so now we are going to take this opportunity to magically whisk ourselves away to, hold on a second here, 4818418 Free Avenue, Jacksonville, Florida, 32211. This could be an NFT, GC, because this is the first time that we share the property eval under the new IRR recommendations, right? This is a first time ever.
Love that.
We're all here for a special moment.
Didn't realize that.
It's a home purchase price of $250,000, 4-bedroom, 2.5 bathroom, 1-car garage. It's got a lease of $1,561. And now the thing that has changed, you got this beautiful picture of this beautiful new construction home here, but this is the thing that has changed, right? Normally we had these 3 evaluations of buying cash, buying non-recourse, and buying estimated conventional financing. Now the deal evaluation says summary of return by purchase method, estimated cash purchase, total monthly cash flow of $1,067. So it's doing the cash, estimated cash flow, total return on investment IRR, 10.01%, and then estimated conventional financing, total monthly cash flow of $48 conventional, financing, and estimated IRR of 13.48%. Talk us through this, GC. What's going on here?
Well, where should we go? Should we go
Yeah.
ROI versus IRR? Or should
Well,
we just talk about this right now?
I think we can talk about this right now, but first I want to know, what does GC love about this property?
Well, I thought you'd never ask. I'll tell you what I love about this property, right? Number one, it's available, right? This is available without needing to be on a waiting list, which is incredibly rare in today's market. When you have the ability to put a property under contract, it allows, and it's available, it allows you to lock in your interest rate right now. And if folks have been paying attention to what the Fed is signaling, they could not be signaling any stronger that interest rates are going to be going up. And when you look at the opportunity for you to lock the same property up today versus doing it 1 year from now or 6 months from now, if you are on a waiting list, your property is much more valuable when you can lock in a lower interest rate today than it would be in 6 months from now or 1 year. So availability is incredibly important, and this property is available-ish. I'm gonna share a little bit more on that. The other thing I love about this is just the incredible amount of success that is right around this property on Free Avenue. This property on Free Avenue is in an area in town called Arlington in Jacksonville. It's one of our 4 major neighborhoods. And in addition to being an awesome neighborhood because it's one of our 4 major neighborhoods, this neighborhood is actually the birthplace of build to rent. The birthplace. We started to buy lots in this neighborhood back in 2011, about 40, 45 lots. And we stumbled across this great idea for us to build new construction homes. And then, of course, turn those into passive income, cash flowing assets for all of you. Hadn't been done before at scale. And so we started to do this. The front page, the Wall Street Journal put us on the front page in 2013. And now, fast forward to 2022, it is all the rage. Wall Street has invested billions of dollars. They're partnering with home builders now to do this build to rent thing. So this home is right there in the Arlington neighborhood. It's got special meaning for me, just knowing that we were there and kind of setting a trend that I think is bringing a lot of value to the marketplace a decade later.
Yeah. So availability, the neighborhood has a special meaning, right? Y'all commissioned that Arlington mural that's gotten a lot of press and really put Arlington on the map. And the birthplace of our friend Billy T. Rent.
Billy T. Rent. He's going to make more of an appearance here soon, right?
Yeah. We're thinking about making a mascot called Billy T. Rent. And we're going to celebrate Billy's birthday, and we're going to make some cartoons about Billy T. Rent, maybe a children's book. I don't know, Greg. What do you think?
I don't know. It sounds like we're starving for ideas. If we're going to that place, I don't know. I don't know if you guys love Billy T. Rent, but I do. Pablo does.
I do. Billy. You're my boy, Billy. You're my boy. All right. So Hervé's got a Q&A here for you. He says, Greg, don't be frustrated. Wall Street uses billions of dollars to advertise their performance, services, ease of use, and perceived benefits. Before it was Fidelity and the likes. Now it's Robinhood that advertises trading stocks like playing a game. Keep using your bullhorn. You are being heard.
Hervé, that means a lot, buddy. It really does. It's something I'm really passionate about. I know you're really passionate about it too, Hervé. And I know you're in this journey, right? You're in the financial services industry. You put your money in the stock market. You have your money in real estate. I think we're up to 6 homes now for JWB for Hervé has 6 homes with us. And I remember how it started off with a few and then it jumped up to 6 and all this. So you've been living this out. You have kind of cracked the code. And, that's not to say that there's not a place for money in the stock market, but it doesn't need to be 90 or 100% of somebody's wealth out there. There's real risk in that. If we could tamper that down and make some portfolios that are more balanced and have real estate be one of your 3 legs of your portfolio, we can do some great things. And so, Hervé, thanks, buddy. I appreciate the message.
Cool. So another little bit of breaking news here. Madison just got herself a nickname in the chat. Bill Shields has named her Madison the Magnificent. I like how that sounds.
I like that. Right. Wait, did that go to the committee? Did the committee approve?
The committee approves.
Committee approved.
Committee approves. I am the nickname in committee here. All right. So let's get into this, right? We got a meaty show. We got some education. GC, can you explain to us the difference between ROI and IRR?
Yeah, absolutely. We can, let's talk about that because I think it's really foundational, right? Return on investment, I think most people get, right? It is what it says, right? You've got your return, right? The amount of income that comes into your bank account for that year, that's your return over your investment. and you calculate that, and you might be looking for a 5% return on investment, or maybe closer to a 10% return on investment. Well, that's really easy when the money comes in 1 year. ROI is generally a 1 year outlook. If you go longer than 1 year, what it does is it assumes that same linear progression where that whatever your returns are, that they all come in at the same rate every year for 10 years. Well, when you get into high level investments, when you get into rental properties, when you get into investments that have multiple profit centers, and some of them come at different points in time, ROI fails to tell the real story. You have to adopt, and what I'm going to bring to you guys now, and what I want us to talk a lot about and become very knowledgeable in, is this concept of your internal rate of return. That's where the savvy, educated investors or business owners live as far as making decisions with their money. It's this internal rate of return. And all it is it takes your return on investment, but it takes into account the timing of when the cash flows occur. And there's real value for you earning money earlier rather than later. So if you're somebody who's considering an investment and you can earn X dollars over 2 years, or you could earn that same amount of dollars over 10 years, it's going to be much more valuable for you to earn it over 2 years than over 10 years. And so your return on investment, your internal rate of return, is going to be higher for a 2-year payback than a 10-year payback, even if the dollars coming back to you are the same. How did I do there?
That makes a lot of sense. That
Okay.
you explained it a little bit different than before when you were trying to explain it to me, and it landed a little bit easier on me. All right. So if we're talking about this timing thing, ROI is a number that is kind of linear, right? Like you just that's the number that you're expecting in 1 year. IRR brings in another time dimension, be it when the money hits at what time, and or, the timing of it, if it's like 2 years or 10 years or however it is. And when I think about it, it feels like IRR, not all investments are linear. I would assume that some of the best investments are not linear because we're counting on this compounding interest stuff, these compounding benefits.
Mm-hmm.
And then in rental properties in particular, different profit centers that hit at different times.
Yeah.
So it feels like a much more realistic tool to understand the benefit.
It is. It is the best way to analyze investments over longer than a 1 year period. Let's talk about the stock market. The stock market's not linear.
Yeah.
When you earn money, you put it in this day, you earn hopefully a lot more 10 years later, but it's not like every year it hit your bank account that you made that step up in profit to get to where you are in 10 years. You waited 10 years and then you sold the stock in 10 years. So while your return on investment would actually be higher, your internal rate of return would actually be lower if it took you 10 years to get that dollar figure than if it took you 2 years or whatnot. And think about it this way, right? If you were able to have, let's say you had $100,000 today and you were able to return that, get that back into your bank account, you could then lend that out, or you could buy something with it. You could earn a return on that investment. So like $100,000 today is not the same as $100,000 tomorrow. It's not the same as $100,000 in 1 year. If you could earn a 10% return on investment, $100,000 today is actually the same as $110,000 in a year. So IRR, internal rate of return, helps you analyze what is that return. How much did your money work for you each and every year when your cash flows may go up, your cash flows may go down. You might have a big cash flow infusion in year 10. It compares apples to apples. It is the standard for comparing all asset classes and putting it on the same scoreboard.
Okay, love that. That's very clear. So let's dive back into the sheet here. Miguel Angel's got a good question that maybe we can explain it based on Miguel Angel's question. Why has the ROI here, right? Like we've been used to seeing these like 5 to 6 to 7 lately. Why has it changed from this typical 5% to this like 13% right here?
Miguel Angel, great question. I love how you're always here on the show asking great questions, and you just gave us a perfect segue here, right? What you've seen on our evaluations at JWB up until this point has not been including all of the profit centers. It has been including net rental income, which is your cash flow. It's been including principal pay down. It's been including tax savings. It's been including all of the costs that come along with as well, but it hasn't been including home price appreciation. But if you think about all these other asset classes, that's the crux of the reason that they say to invest with them. In the stock market, it's not typically about dividends, even if you get them. It's about stock price appreciation. If you're investing in syndications, they're always putting on what they think the house value or whatever investment value is going to be in 5 years or 10 years. So everything else is including home price appreciation. I'm fed up. I like to underpromise and overdeliver. We still are going to underpromise and overdeliver with our evaluations, but it's just not a fair fight. It's like rental properties having two hands tied behind your back, going in and facing Mike Tyson. If everybody else uses home price appreciation or stock price appreciation to help you convince yourself that you should invest with them, well, you got to compare apples to apples. So simple answer here, Miguel Angel, is the reason you're seeing 13.5% now is that because this includes the historically accurate average home price appreciation rate in Jacksonville. And you can see that right here on the evaluation. That's 4.6% per year is what Jacksonville real estate has appreciated every year since 1982.
There you go. So long answer. It's the inclusion of the appreciation rate and the inclusion of the appreciation rate within the time period of
yes,
1 year.
That's an important point. So here's something else that many other turnkey providers do. A lot of turnkey providers have put home price appreciation on their evaluations, but they don't compare it in terms of an internal rate of return. They don't take into account how long it takes you to get the appreciation, right? The internal rate of return takes the number of years that it took for you to receive that home price appreciation, because it comes in a lump sum at the end. And so here's an example where you can look at another evaluation in another rental property market from another provider, and it may say your returns are 25%. And that's assuming that you actually receive that home price appreciation year one. 25% ROI might be the same thing as a 13.5% IRR when you account for the amount of time that it really takes for you to receive it. So this is why I hope this scoreboard is something that you use in your investment decisions. For the ones that are about buying rental properties with JWB, that's amazing, right? I want you to use it beyond that, right? You need to know how hard your money is working for you when you have variability of cash flows. Some years are going to be super high, right? If you were to refinance the property and you had an infusion of capital, that really skyrockets your internal rate of return. When you sell the property, that really skyrockets your internal rate of return. And it's the baseline. We got to use it.
Got it. Okay. So then is Bill Shields right in what he says? Isn't that number normally over 20%? Is that because it's for 1 year?
That's the difference between just a simple ROI calculation and an IRR calculation. It would be like saying, listen, let's say that, your property is a $100,000 property, right? And it has 5% home price appreciation in that year. I'm just using round numbers here. That's like saying after 1 year, you were going to receive $5,000 more of return and jumping up your return on investment. And that's how it might get you to 25% or 20% or whatever. But that's not really how rental property investing works, right? How it really works is you buy and you hold for a full market cycle, for a 10 to 20 year market cycle. That's how investing in a syndication works. You buy and you hold. Sometimes it's a 5-year hold. Sometimes it's a 10 or longer year hold. That's how it really works in the stock market typically as well. People typically invest, not everybody, there are some day traders and whatnot, but generally people buy and hold in the stock market for a long time. So this time value component is really, really important. The longer it takes for you to actually receive the money, the lower your internal rate of return. And you just wouldn't see that if all you were looking at was your standard return on investment calculation.
Got it. Okay. And just from on like a personal level, right? Like if we're going back to the why of your frustration, right? The why of your frustration is you believe that Americans and people around the world are under invested in real estate because they don't fully understand this asset class the way that they should, to really understand how risk mitigated it is and how much better the upside is and the average kind of return is in comparison to the things that they're used to.
Right.
I would assume that changing this IRR means that most other investors, when they're evaluating other investments, they're being hit with this number and it looks differently because they haven't been comparing it apples to apples. So then when they came to you and they were getting hit with an ROI number that wasn't comparing apples to apples to IRR, they were having a hard time getting over the initial, just like, well, it's 13.46% on the IRR. So what are you going to do?
Yeah.
This one's 6.
Why isn't it 25%?
Is that it?
I mean, we wouldn't make a big decision like this. This is a foundational change for how we're representing our evaluations. We have been having those conversations with investors who wanted higher returns since day one in 2006 when we started our company, right? So we've always had those conversations. This move isn't about satisfying those folks who want higher returns. It's more about just foundational. I think this is an opportunity to help investors make better decisions. It's what we believe. It's how I analyze investment opportunities. It's how my business partners and I analyze investment opportunities. The reason we haven't done it in the past is because it's complicated, right? I want to still keep it simple enough that people understand. And so I think today is the first, hopefully, in many, many conversations and many questions that you all will ask about what is an internal rate of return and how can I use this to make better decisions. But this is a pretty foundational thing that we're doing. It's not just because, of what you pointed out, although that happens often.
Okay, got it. Cool. So when it comes to smart IRR questions, Bob Wiesner is somebody that asks smart questions. He asks in the chat, what discount rate are you using to calculate the IRRs on this?
Well, so that's really what an internal rate of return is. A discount rate is basically the rate of return your money had to earn each and every year to make the net present value of the future cash flows equal to 0. So there I just went way complex. Let me start back over, right? The discount rate basically says how hard does your money have to work for you so that at the end of this 10 years, when we got all of this pile of money back at certain timing and whatnot, what return would I have had to earn each and every year to equal that big pile of money taking time into account? So 13.5% right there, that's what your money is earning each and every year over a 10-year internal rate of return calculation for this rental property based on all of these factors. So,
okay. So then if you were to say, so what is the discount rate?
13.5%.
13.5%.
Yeah.
Okay, cool. Just checking. Great. I kind of understood that, but I'm assuming there are more sophisticated investors out there that get that.
Take discount rate and just equate it to your, let's just call it your total return on investment.
Okay.
Right. That's really what we're analyzing here. That 13.5% says your money's working that hard for you each and every year. Even though some years you're getting a lot more in your bank account, some years you're getting less, some years you're getting a lot more, some years you're getting less. 13.5% is what it's earning every single year to get you to the finish line.
Got it. Cool. So we're going to dive deeper into IRR. David got a great question and our friends from France have a great question as well. We got a couple more just observant regulars asking some questions here. And one is Taryn Cullen. Actually, Taryn, that's a name I don't recognize. Thank you for.
I believe Taryn just purchased a home this week. I was checking internally. So congratulations, Taryn.
All right, Taryn, congrats. Love you chiming in the chat. Check in on the roll call. I want to say your name, right? All right. So Taryn says, regarding 3.3% rent increase, how many years does that go back and what was it last year?
So that goes back from 1985 all the way through last year, which is the most recent data that we have. And that's coming from John Burns Real Estate Consulting, the industry standard for data in our space. So that's 3.3% since 1985, year over year on average. Your rents have appreciated that in Jacksonville. Last year, the latest data that I saw was 10.5% year over year, although I think that is a little bit outdated. Rents have gone up significantly, so I would imagine it was a little bit more, but that's the last data that we have available.
All right, cool. Is that something that I missed? You said something about a 3.3% increase while explaining IRR. Was that Taryn bringing that from something?
No, he was just looking at the conventionally financed tab.
Got it.
And then you'll see that.
Got it. We're going to dive into that.
Yeah.
We're going to dive in. And everybody says, team, I might have missed it, but what time frame is being used to calculate these IRRs? 10 years.
10 years.
10 years. All right, cool. And then Miguel Angel has got a question. I noticed too that you reduced the vacancy rate by 1%. Any reason? So we got this vacancy rate of 3%.
We didn't reduce the vacancy rate. It's always been 3% for new construction homes. Miguel Angel, what you're probably noticing is that for new construction homes, it's 3%. For renovated homes, it's 4%. So you have a slightly higher vacancy rate for a renovated home than you do a new construction home.
Got it. All right, cool. So now let's dive a little bit more into this, right? So David Singhi has a question. He's asking, would love to see some case studies on client portfolios using the IRR versus ROI method. Hopefully one of the future client guests will be open to that. Is that, I mean, first of all, are we going to do that? And B, my other question is, are you using IRR right now when you do the This Is Your Life thing?
I am.
Okay.
I have been doing this IRR calculation for all of you as a part of our guest investor on our Thursday show. So I've already been doing it. You know, if I was to use ROIs only, the returns would have been so much higher than what I have been showing you. So we're already there, David. I love that you're here and keep tuning in. You're going to keep seeing it. And maybe what he's asking is maybe a comparison between ROI and IRR to like show what the difference would be. So yeah, I'll include that for next Thursday when we have our guest investor. I'll show the difference and just to see the kind of like that 25% versus 13.5%. And how does that really equate apples to apples?
Love that. And we love our regular listener tuning in from France. Anonymous Atinde is asking, can you share some details on what is IRR and what it includes? I heard your definition of the time period, but more on how it is calculated will help. Was it be the time to go to the analysis conventional financing tab?
Yeah, let's do that.
Let's do that.
Perfect.
All right. All right, cool. So should we go with the top part or how do you want to start this, GC?
Let's focus on the simple thing here. There's a lot of numbers on the conventionally financed tab. I think if we go through all of them, that's not the purpose here. If anybody wants to go through all of these numbers, get on the phone with my team. This is exactly what we can walk through with you. Let's go to the bottom here. So this is your internal rate of return calculation. We're just going to call it total return on investment because IRR and internal rate of return scares people. I want to make it simple because it is simple if you think about it, right? Let's zoom in, maybe just columns F and G. Yeah, there we go. And just the IRR part. So your total return on investment, right? This is a statement of cash flows. Think when I say cash flow, think of money hitting your bank account or money leaving your bank account. And so in column F here, right, you're seeing your first year and you've got the outflows of cash and you've got the inflows of cash. So that down payment there, when you're putting 30% down on an investment property, I think the purchase price is what, $250 on this one, right? So you're controlling a $250,000 asset. That's like you buying a $250,000 share of stock, but you're only putting down $75,000. That's really important as to how we beat long-term. That's how we beat the stock market. That's how you as an everyday investor can beat Warren Buffett. It's because of leverage. But $75,000 actually is leaving your bank account. So boom, outflow, $75,000. You've got closing costs, right? A little bit over $8,000 of costs that come along with buying the property. That's an outflow, right? We're accounting for that. Most turnkey rental companies don't do that.
That would be like if you bought a stock, it'd be like your transaction charge.
Sure. Okay. You're whatever they used to charge you $7 per trade or whatever. There's your $7 you could put there.
Got it.
If you're, however they do it now. Now it's free, but they stick you on the back end if you're a Robinhood investor, apparently. Then you've got net rental income, cash flow. Well, this is really interesting. I talk a lot about positive cash flow investments. Pablo, why on earth is this negative cash flow in year one?
Tenant placement fee.
Tenant placement fee, right? We're including all of the fees. You don't see that in other turnkey rental property investment portfolios out there typically, but this is actually how it works. You want to pay a tenant placement fee your first year because that means you have a tenant. Yeah. So there you go. Tax savings. This is money that you don't have to pay come tax time in that year. So you save $2,455 of real dollars that you don't have to pay in taxes because of this asset class. You don't get that in the stock market. And then you've got these other profit centers, principal pay down. Love principal pay down. That's where your resident pays your loan down for you. You got 2 residents right now in your 2 JWB rental properties, right? They're paying $100, $200 a month off of your loan each and every single month. That's great. How cool is that, right? Yeah. But that doesn't hit your bank account this year. Right? You're not seeing that in your bank account. It's paying down a future liability for you. So while it's there, it doesn't show up year one. It's really important, that concept there. It's only if it hits your bank account. Then you've got home price appreciation, right? We're counting in 4.6% appreciation every year because that's what history has taught us over a 10 to 20 year cycle, but it's not hitting your bank account year one. If I was putting it in there, we'd be getting closer to those 20 or 25% returns, which is what a typical ROI would be. And then selling, holding, and closing costs, of course, that doesn't come to the end. So your annual capital in that's how much money, counting all of that, has actually gone out. And you do that for a 10-year period of time. You kind of go through the years here, right? You've got net rental income, you've got tax savings every single year. Well, as we go to the very end, the 10 years, the 10-year point, it starts to get really fun and exciting. You got a lot of numbers there, right? At the top there, you get your $75,000 down payment back, right? When you sell the property, you don't get your closing costs back. So that's just loss. We would love for that not to be, but it's just the way it is. You've got your net rental income. It still happens that year that you sell it. So you made about $3,000 in net rental income. You still are getting your tax savings for that year because you owned it for a year. So that's wonderful. But now you really see the impact of these other profit centers. Principal pay down, your resident paid down $30,000 of your loan for you after you hold on for 10 years, even if you didn't make any additional principal payments. Like, how amazing is that? If you need another reason to want to take care of your residents and treat them like gold, here's $30,000 of reasons to do that. Then the next one is your home price appreciation. On the show here, I have talked about how narrow-minded it is to only make decisions based on cash flow. And the reason is shown here. It's because the majority of your returns on investment in real estate over a full market cycle will come from home price appreciation. That's why choosing the right market matters so much. Well, here you see $142,000 of gains, of equity gains from investing in a property that's in a market that grows at 4.6% per year every year. It's incredible. I mean, how does that, that makes cash flow pale in comparison, right?
Yeah, I was just thinking that if this cash flow was zero,
it doesn't really matter that much.
Doesn't really change it for me here. Yeah, correct.
Exactly. Yet so many people out there are like, listen, I'm only going to choose the market because it's low price and because I can get higher cash flows. I'm not going to pay attention to appreciation. Like, don't you feel like they're just missing out on the big deal?
Totally missing out. Yeah.
Well, this is what this IRR, right? This is what this total return on investment calculation can do for you if you start to use this to analyze opportunities. But we do need to take into account that selling real estate is more costly than other places. It's more costly than selling stocks, right? Generally, you hold back about 10% of the sales price in terms of paying for your real estate commissions, your holding costs, your closing costs on the back end. So that's just a generally accepted standard there. So you take 10% of whatever that sales price is, and that's another cost in the back end. And you're left with this huge inflow in the last year. And so as we go back to what IRR means, it's like you got like $2,000 coming in a year, $3,000 coming in a year, maybe $4,000 coming in a year. And then you got $212,000 coming in year 10. How do you come up with a metric that tells me what percentage would I have had to earn each and every year, knowing that cash flows come in at different times? That's what IRR does for you.
Okay. That was a pretty good explanation, right? Like seeing it go through the years and then finally this last number and putting a solid timeline to it of 10 years makes a lot of sense. And now you see the numbers here kind of come to life. And then Moose has a follow-up question of, does the conventional financing tab include increasing taxes or insurance to the calculation of the return?
It does. So it includes operating expenses increasing at a rate of 3% per year. So that's included there.
Okay, there you go. Here it is. All right. We've got Robert Wiesner again asking, there have been substantial increases in inflation rates recently. If inflation escalates more in the next 12 months and persists thereafter, would you anticipate that the depreciation rate will increase proportionally?
Bob, great question there. Inflation is on the mind of all investors out there. And if it's not, it should be. And I don't think inflation is going down anytime soon. So it's going to be here for a while. The question is, would I also expect that home prices will continue to appreciate at a rate that's similar to the inflated inflation rates? I don't think it's that simple. I think that is important. But, the thought process, one of the reasons I love to invest in real estate is that it is a hedge against inflation, which means that over long periods of time, your rate of home value appreciation tends to go up and probably beats the rate of inflation. And it's because the cost of goods to make houses tend to go up. So builders still need to get a profit. And so their sales prices tend to go up. So, but that's over long periods of time. I don't think you can use that and say that home prices are going to go up next year just because inflation is going to be 8% next year. It doesn't really work out that way. It's kind of, you got to look at supply and demand. Number one, right? We're way undersupplied in the housing market. Demand is still high right now. I do think that home prices are still going to be going up. I'm saying 8 to 10% year over year here in 2022. So I still think you're going to get there, but it's not because I'm tying it to what inflation may be. It's more of other factors that are getting me there.
Awesome. Yeah, I see us talking about that more in the future. For right now, let's knock out a couple more questions before we wrap up the show here. Bob with another great question. Bob Wiesner asking question about the taxes. What about capital gains on the price increase? And what about the taxes on the depreciation you have taken?
Yeah, great question. So talking about taxes here, on this evaluation here, I'm not talking about the fact that you actually do have to pay taxes on the gains that you get after you sell it, right? It's kind of equal. If we're talking about a 10-year hold for a share of stock and a 10-year property that you held for 10 years, right? After you sell the property, you have to pay capital gains, which, recently has been about 20% of you have to pay in the form of taxes. So you have to do that in the stock market. If you held on to something for 10 years, you have to do that in real estate. In real estate, you have other ways to potentially defer that using a 1031 exchange or other avenues that you don't have in the stock market. But for the purposes of this evaluation, I'm assuming that you're going to have to do that after you sell it. And it's the same in a syndication. It's the same in the stock market. It has been 20%. It most likely will be going up. So no difference. You're still comparing apples to apples. We all have to do it, or at least that's the assumption. What you're seeing for tax savings on this evaluation is something additional that you get because you're invested in rental properties that you don't get in the stock market. This concept is that you're able to take a non-cash deduction called depreciation every year that you own the property. And what that does is it decreases the amount of taxes that you have to pay each and every year, no matter when you sell. Right? You could hold on to this thing for 10 years, but for those 10 years, years 1 through 10, you were getting that extra deduction in real estate that you don't get in the stock market. So that's depreciation that we're talking about there. That's what you see reflected on the evaluation. Capital gains, I'm assuming it's the same for everybody. And so after you make this nice gain, even in the stock market, in syndications, in rental properties, you're still going to have to give something back to the government. And it's historically been about 20%.
There you go. All right. Jillian Noel writes, Ohio has cheap prices, but I don't believe the homes appreciate like some markets. The rental market is strong, though. I like the Florida market, but the homes are pricier.
Jillian, you just shared what's in the minds of many investors. And, I'll give you some data to support it, right? Purchase prices in Cleveland, which I love to talk about, are a lot lower than what they are in Jacksonville. We actually did a show comparing the 5 comparable cash flow markets, but prices are a lot lower. But you know what else is a lot lower? Home price appreciation rate. If you go back from 1982 to 2022 and you looked at what the rate of appreciation is year over year over year, the markets with the highest population growth are also the ones that have the highest home price appreciation. In Jacksonville, as we've mentioned, it's 4.6% per year. I don't remember it off the top of my head. I want to say Cleveland is 3.2% per year. That may not seem like a lot, but it equates to hundreds of thousands of dollars of difference over a 10 or a 20-year hold on just one property. Like that's how big of a difference is choosing the right market. So Jillian, you have to understand about what's important for you. If you are just going straight with cash flow and you just want the best cash flow for your dollars that you can put out, Cleveland might be a great market for you. Understand what you'd be giving up though. After doing this for a 10-year IRR, this property versus that same property in Cleveland appreciating at a 3.2% rate every single year, you'd be, I don't have the numbers in front of me, $50,000 to $100,000 light for your Cleveland property versus what you would earn for your Jacksonville property.
There you go. And David Singy is putting in the chat, Jillian, totally understood, but the Jacksonville and the neighborhoods JWB play in are top tier appreciation assets that still cash flow. I talked to them back in 2016 when I graduated college. I wish I had saved earlier and bought sooner with them. Their homes were 95 to 120K. I just closed my first one with them at 177K. So yeah, man, we were just talking about this. Well, spoiler alert, there's going to be a show talking about how JWB neighborhoods actually appreciate more than other neighborhoods, even in Jacksonville, because they're vertically integrated. Hervé's got a question here before we end with his comment. He puts, Greg, with recent well above average appreciation rates in Jacksonville over the past couple of years, when will increase your market cycle average above 4%, i.e. maybe go to 6 or 8%?
A great point there. What Hervé is pointing out is that 4.6% average appreciation is way low if you're only taking the last 2 years or 5 years or 10 years. If you actually use the number from the last 10 years, it's about 9% year over year home price appreciation. But this is reflective of how internally here at JWB, we want to represent ourselves. We want to underpromise and overdeliver. And it's also about the long-term belief that things come back to the norm, right? So we believe in 20 years when we're doing this show and you all are here tuning in, and I don't know, maybe we have nanotechnology and we're all, I don't know, flying in on saucers or whatever, that we're still going to have roughly about 4.5, maybe a little bit higher home price appreciation year over year in Jacksonville. So I don't see us changing that, Hervé. We look at the 40-year home price appreciation average. Usually I look at it about once a year, and we'll make some updates in that way. But, that number doesn't change a lot. I don't see us going to 6% or 8%. And, it's that belief that there's a regression to the norm.
There you go. And breaking news, Jen Filson just posted the highlight reel video from the Denver meetup in the Facebook group. Go check it out. It's in the chat. You can go straight to it. I'm going to finish here with Hervé, what he said a little while earlier. He says, Greg, couldn't agree with you more. The $1 million question, is there a way we can make the cost of entry into real estate the same level of cost of entry into buying stocks? A lot of people starting their careers in 20s and 30s would love to get into real estate, but they don't have the capital to do so. So their first investment by default becomes a stock market. And that's why they stick, because Wall Street tells them you need to build your portfolio over the long term, dollar cost averaging, buy on the way up and the way down. Do you think that's what it is? Is it entry point, GC?
I love where Hervé's going, and I think entry point is a big part of it. And I also think it's the way that the model is built it's what's pitched to people coming out of college as like what you're supposed to do. It's like it's an ingrained thing. Parents, moms and dads tell their kids, get a good job and invest in your 401k. And you can't invest in real estate in your 401k. And people, if they do that, then they turn their minds off to everything else because they think that they're doing what they should be doing. It's not real. It's a fallacy to think that just investing in your 401k plan is going to get you where you want to go when you want to get there for most people. The better way is to understand what we're talking about here, understand how smart leverage, smart debt can help you get to your goals quicker. Do it in a way where you mitigate your risks, where you have income coming in every single month. Don't do it just to put a little money down on something highly speculative. Like these concepts, and when you do it when you're young, oh my goodness. If you can do this in your 20s and in your 30s, you can create a much better family structure later on in life. I think you can create a much better community. You can create a much better world. I really believe that. So with you, Hervé, the wheels are turning internally for me on how we can make that happen. A lot of challenges to being able to limit the ability to, or limit the down payment for non-accredited investors, but it's near and dear to my heart. So I'm going to keep fighting till we get there. He
says you're 100% right. The other thing that I've noticed is when I have these conversations is people don't realize I think it's what you used to say a lot, right? Like people think that it has to be really hard.
Yeah.
And I think it's really difficult to understand how easy it is to do it through JWB unless you are a not your average investor, tuning in every single week, listening to the stories of everybody, living it yourself, right? Like the idea that I've been close to eviction twice in a property and I have not felt it in any way.
That's cool.
Because it's completely vertically integrated and I just got to pay attention to an email once a month and all these things happen while I'm getting a 56% IRR so far, something like that you showed me.
Yeah.
I mean, it's
Appreciation.
it's this idea of like, see it to believe it. This like, I don't know what it feels like to do with other turnkey providers, but the JWB experience is very much like a see it to believe it, which is why we're here every single week, which is why we never take it for granted that 43 people stuck with us for an hour of their day in the middle of a Thursday, hanging out with us. I can't tell you what that means to us. And the fact that there's meetups happening in Denver and meetups happening there's one coming up in Pittsburgh now. And then we got the super duper meetup happening in Jacksonville. I hope that you can join us. This is really, really special. If you're on the podcast, really appreciate that you're listening to us while you're walking your dog or cooking or driving. I'm really just saying the things that I do it with, but I love that you're listening. Keep paying attention. Join us one of these days. It's as fun as it sounds. And what do we got coming up on Tuesday, GC?
Our buddy Andrew, right?
Our buddy Andrew Smallwood.
Yeah.
It's going to be good.
You or me. I can rave about Andrew.
Go for it.
All right. Well, Andrew is one of my best relationships in the property management space. He comes from a company called Second Nature, who serves the best property management companies in the country. We're one of them. We're one of his clients. And you want to talk about somebody who really understands how to treat residents, how to work with property managers who think the right way about long-term residency so that the owners of rental properties can win. There are not many thought leaders like Andrew in this space. And so he's going to come on Tuesday. We're going to talk a lot about what the best property management companies are doing across the country. It's going to be a wonderful learning experience. So I hope you all join us.
Yeah. Andrew's the guy that when I first met him, I'm like, you got to meet Gregg. Like you guys both have this like amazing way to communicate, great marketing and business leadership minds, believe in the same things. I'm super pumped to like bring this thing together and be a fly on the wall of your conversation. Hope you join us. Stick with us today, right? Like you're about to become an IRR ninja, right?
Yeah.
Like I know Gregg is about to really just drop it on everybody and we're going to get deep into this IRR. Follow along. GC, I'll give you last words.
This has been awesome. Thank you guys for giving this platform. Thank you for coming in with an open mind and all about the education and the learning process. I think the deeper we can dive and truly creating this scoreboard and removing the different lingo from one asset class to another, I think you all are going to be much better served as investors. I think you're going to help impact your families better. You're going to help impact your friends better. You're going to be able to have these conversations. So I'm excited. I think this is a pretty cool moment here. So thank you all. Thanks for being a part of this community. Can't wait to do it again next Tuesday. We'll see you guys there.
Stick around with me, GC, and the magnificent Madison as you continue to be not an average investor.